All right. Hi, everyone. Our pleasure to be here today discussing what we're seeing in the real estate technology M&A market in 2020. We want to thank CREtech for hosting another great conference this week and for having us here for this discussion. First, just a quick overview on our agenda. We'll provide a brief update on the overall M&A market trends in 2020. We'll discuss some trends in deal structuring, and then we'll provide an industry-based view of deal making in the real estate industry right now. I'll speak to that piece versus in tech, and my partner Ali Simons, who's on here today as well, will discuss that side. Ali will also get into some more details on the technology side, including the types of assets that she's seen as active with consolidation and that have also become attractive acquisition targets in the market. And finally, we can take any Q&A. On PropTech M&A market trends in 2020 so far, overall deal flow has been solid despite the COVID macro headwinds. The emergency stage that existed for the first couple of months in the pandemic in March, April, and May, during which we were focused for clients on lending, employee headcounts, G&A strategies, et cetera, has subsided for the most part. And we have seen a shift to the return of ordinary course operations now. Companies are revisiting acquisition strategies and deal pipelines. As far as a snapshot of deal flow data in 2020 so far, the first half of 2020 saw a decline of only 7% year over year in capital raise activity in the PropTech market, despite COVID-19, and Q2 saw actually a 92% increase in invested capital year over year, driven by large investments in category leaders Vacasa, Airbnb, and Sonder. There was $4.3 billion in growth capital in the US raised in the PropTech space across 135 deals through June, and 36 PropTech M&A transactions through June. 76% of M&A buyers in the first half of 2020 were strategic buyers, while only 24% were financial buyers. This reflects that many of the well-capitalized scale leaders in the industry are further extending their competitive advantage through M&A strategy this year. Our belief overall is that the pandemic's impact on the real estate industry will result in the growth of real estate technology and related M&A. In some real estate sectors like retail, office, student housing, senior housing, just to name a few, we're seeing technology as a real necessity to bringing operations back to normal or to a new normal. And in some cases, acquisitions of assets has been the strategy to accomplish that end. But despite the solid M&A market thus far in 2020, deal execution has been tighter. Sellers really need to identify an established use case to get deals done right now. And buyers have the opportunity in this environment to see whether companies that they may want to acquire have been able to effectively operate through the market distress over the last several months with resiliency. And in most cases, buyers are taking that extra time and due diligence to look at that aspect of a target's business. Also, certain revenue models have been impacted less than others. In this market, the core business model really matters. Enterprise versus B2C, recurring subscription revenue versus one-time transactional models, and fixed asset costs versus variable costs that drive preservation of revenue are really critical factors in business and financial due diligence. And those issues, to the extent that buyers can't see those aspects demonstrated in the business, can really halt a deal altogether. Having a high growth model but an inability to demonstrate a path to profitability is a harder sale model this year. And as I said, recurring revenues are important, and service heavy models that rely on new customer flows have really struggled. And finally, scale matters. So scale platform solutions generally have demonstrated the ability to weather the economic slowdown this year and have emerged as leaders in M&A and consolidators going forward versus point solution. So the trends that we were seeing in the PropTech industry prior to the pandemic, with winning companies differentiating themselves from smaller scale businesses, that trend is continuing this year, and M&A consolidation is furthering the trend. On the legal side, in terms of negotiating deal terms, buyers have leverage generally now to negotiate for an ability to get out of a pending deal if there's a material change to a target's business post-signing. And overall, in deal terms right now, there's much less appetite for risk on the buy side. Where there are any uncertainties tied to a target's valuation, we're seeing buyers jump right to earnouts and other contingent consideration structures. Due diligence is more extensive and being conducted over a longer period of time in the pre-signing period for a deal. And part of that is that we have lost the efficiency of face-to-face meetings, which has, of course, been the traditional model in M&A deal process. Again, in diligence, buyers are examining resiliency in the business and focusing on getting to a firm conclusion that a target company presents a compelling use case. If deal financing is needed, it's harder today to get acquisition capital, so that presents an additional hurdle, and that's why we're seeing less financial buyers for the time being this year. As far as trends with strategic deal structuring, and particularly on the real estate side, there's a steady flow of distressed sale scenarios. These deals typically do not involve ideal pricing, of course, but in many cases are a result of less access to capital and continued cash burn. And as early stage prop tech investing has slowed on a relative basis to prior years, we're seeing an increase in other alternative strategic structures, particularly joint ventures for real estate partnerships, some of which have a propco-opco type structure where the property company will own and purchase the real estate and the operating company manages the real estate, similar to how hotels are operated. This may be viewed as a better structure for the respective real estate and tech business models because it allows the investment sources to stay consistent with their traditional investment theses. The property company is financed like a real estate company with debt and real estate investment sources for the equity. And the operating company is financed like a software company, which Ali can speak to, by VCs and venture debt for the technology, branding, and people aspects of the business. We have advised on several of these types of transactions, these partnerships this year, and they're becoming attractive and a relatively low risk option for real estate operators that may desire to try out partnerships with a technology company that may enable the real estate business in some way, but where there may not be a desire to do a full company acquisition. The JV structures based on how the operating agreements are negotiated for these partnerships have also resulted in more companies considering minority buyouts of JV partners if for some reason the relationship doesn't stand, and debt to equity exchanges if entities have been initially capitalized with debt. We're also seeing activities with spinoffs. So a few examples in the industry are the Sidewalk Lab spinoff of Replica and the Westfield Lab spinoff. A spinoff offers an effective strategy, for example, for advancing branding of a product line out of a well-established later stage asset, with the SpinCo being able to continue to draw from capital from the existing relationship with ParentCo. This is effective as, again, it may be difficult to attract new capital in this market. Spinoff can also be utilized in the context of an straight M&A disposition, or a status quo SpinCo from ParentCo for an internal corporate restructuring. Sometimes those corporate restructurings are motivated by tax efficiencies. In the Sidewalk Labs deal early this year, Replica spun off and simultaneously closed the Series A round. So there's also tail end capital raising that can be deployed. Finally, on deal structuring, 2020 has been the year of the SPAC, which has been well reported. This is a hybrid between an M&A transaction and an initial public offering. A SPAC is a company, just briefly, formed to raise capital in an IPO, the proceeds of which finance a subsequent merger within a specified time frame that's typically 18 to 24 months, before which the SPAC vehicle must liquidate and distribute the IPO proceeds back to investors. So it's a relatively safe vehicle from an investment standpoint. The target M&A company becomes public as a result of the back-end M&A transaction. That's often referred to as a business combination deal or the de-SPAC transaction. So far this year, a total of $30.4 billion of capital has been raised by SPACs in over 75 IPOs. For companies seeking a relatively clear path to the public markets, SPAC transactions offer certain advantages, especially in today's volatile market conditions. Some companies might prefer the pricing transparency offered by a SPAC and then the speed to the public markets as compared to a traditional IPO structure. Notable PropTech SPACs launched this year are PropTech Acquisition Corporation's merger with Porch and the IPO of Sam Zell's Equity Distribution Acquisition Corp, which is targeting a de-SPAC transaction with tech-enabled solutions in the industrial sector. And now I'll hand it over to Allie, who will discuss the key technologies that she's been seeing as attractive targets in this market. And she can give more of a view of business dynamics on the tech side of the equation and in the M&A deals that she's leading.
Thanks, Blake. And I wanted to take a moment to zoom out just a little bit and give you, I guess, some context about a lot of what Blake just went through. So, in the universe of industries, I would say that Blake exists on the real estate side and certainly on the prop tech side, further along on the tech side, and then coming to the middle on the prop tech side. So my frame of reference is going to be much more what is going on in the tech world, with prop tech being a subset of the tech universe. With that in mind, I will point out that M&A across all industries over the last year has plummeted, right? The numbers, everybody's seen the graphs and everything else, and it's really dropped off a cliff. The exception to that has been tech. Tech has, there has been some decline, but tech's volume was at such a high point going into this year that some decline is still a very high volume. There's a lot of transactions going on in tech. I actually think sometimes that there's a little bit of survivor's guilt happening right now because of, the difficulties that the economy and the world is having, and yet tech survives and succeeds and does well. So, that's all to say that we're all very busy, is one way to think about it. But that also means that tech acquirers are busy. Private equity sponsors who acquire in tech are busy. Real estate companies who are buying tech are busy. There is competition, and there's quite a bit of competition for targets that are attractive in the prop tech space. So, as we talk about, and we think about, new structures and earnouts and ways in which buyers are pulling back or being more careful, we have to temper that with the reality that there is competition in the market. And so, if there is a hot target, then it's going to have to swing back a little bit in the other direction, and buyers are going to need to figure out ways in making their offers more attractive, as opposed to flipping it around. If you have a bespoke technology that can only be used for, limited purpose, then yes, 100%, that's going to be a buyer side deal. But I think, to everyone's surprise, to be very honest, it is still, in a lot of cases, very much a sell side market. So, how does that play out? I think that, as Blake mentioned earlier in the call, in a lot of instances, technology is going to be core to, returning to some semblance of normal. But in many instances, that's going to mean going into areas of technology that the real estate industry was not considering before. The obvious players, Airbnb, that's a classic prop tech example. We know about that already. Where are we seeing activity, or where is there potential for activity that hasn't been, fully vetted out yet? Cybersecurity. Going into this year, cybersecurity was marked as an industry in which there was a ton of consolidation to be done. So in other words, there was a ton of M&A to be had. There was a lot of different solutions on different platforms across the board. They needed to be consolidated to be meaningful to any particular enterprise. How does that play into the real estate space? Well, as prop tech grows and real estate technology grows, all of that technology needs to exist on a secure platform. There isn't a month that goes by that we don't hear about some sort of privacy breach or security breach, or a company being hacked, or people's personal information being sold out on a black market. And, that's every large company, it doesn't matter what industry, that's every large company's nightmare, is that that's going to be the case. And so, if you're a sophisticated real estate company that's doing significant investment into the tech space for a variety of reasons, part of that strategy needs to include cybersecurity. And if it doesn't, then, you may as well be writing off half of your investments. And so how people are approaching cybersecurity deals, what are the kinds of cybersecurity companies that are meaningful for a prop tech or a real estate acquirer? I think that that's going to, increasingly get a lot of attention. And by the way, that is a very competitive market as well. As I mentioned, it was ripe for consolidation to begin with. And, this is only going to add to that tension. Another area that, is an interesting one is gaming. So going into this year, gaming was doing pretty well. Through this year, I think gaming is an industry that has exploded manyfold. The definition of gaming has changed. Gaming is not just a bunch of teenagers sitting around a screen, a TV screen with a device playing a game that most of the rest of the world has no idea how to play. That's not gaming anymore. My mother probably plays more Candy Crush than anybody I know. She certainly is a gamer as it's now defined. The revenue for gaming is through the roof. And of course, with COVID, a lot of people with a lot of time on their hands are spending a lot of time playing. There's a ton of revenue in that. Now, one of the new parts of gaming that were coming into vogue a couple years ago was gaming competitive teams. A lot of universities have Division I gaming teams. Gaming competitions is a huge market. And the corollary of that is people do sit around in person and watch gaming, which means you need gaming arenas. And as retail spaces empty out, as movie theaters empty out, what are ways to repurpose that real estate? Even before COVID hit, people were considering turning these things into gaming arenas. With COVID, that goes a few steps further. You obviously need the right spacing and everything else, but can a lot of these newly empty spaces turn into gaming arenas? There's a lot of money and a lot of thought being put into that right now. So what goes along with that? Technology sponsorships, all of the equipment, media and other kinds of deals. So there's a lot that, as you see the, usage for public spaces changing, there's a lot of other things that come out of that as well. Okay, so getting everybody back into buildings, how do we do that? The technology involved there, it's a lot of volume measurement, people tracking. GPS technologies are certainly sort of a hot commodity right now. The same with tagging technologies. Everyone's talking about being able to tag people's phones when they come into the building and then track them around and know who they came in contact with. The whole contact tracing. And, contact tracing is something that, again, the competition comes from. You have municipalities that are acquiring contact tracing technologies. You have private equity shops saying, hey, this is going to be a huge opportunity. We want to consolidate a bunch of contact tracing technologies and license them out to, for as high as we can get prices for. If you are a large real estate developer that has a lot of properties, a lot of multi-use properties that normally sees a high volume of individuals, it's going to be an almost necessity at some point that those buildings have their own contact tracing technology that then can be licensed to the tenants. I mean, there's the possibilities are endless there, but there's a lot of into that. So I think that's another one. And then, stepping back out again to other types of prop tech that we were seeing, as a very, very interesting space going into this. And that's looking at the real estate buying process, everything from fintech and how mortgages are issued to how personal real estate is acquired. The home buying process, and for that matter, the commercial real estate buying process, is a historically pen and paper kind of industry. And there's been a huge move towards digitizing every step along the way. And you have very large players that have gone into that market. And I think with COVID coming into play and, your local notary shutting down, bank branches shutting down and having odd hours, all of those things lead to a higher demand for digitizing these old industries that are still reliant on pen and paper and old processes that need to be updated. So I think that there's been an acceleration of demand for those things as well. Moving on to what are we seeing in tech deals generally, as I mentioned earlier on, it's actually been very competitive. For the more competitive processes, we're not actually seeing a lot of earnouts. We're seeing a lot of rep and warranty insurance, which can be a great solution, especially if you're trying to compete versus private equity acquirers. In the private equity universe, I'd say that rep and warranty insurance is status quo. It's table stakes for making an offer. And if you are, let's kind of make some assumptions. Most technology companies are going to be venture backed, maybe private equity backed, but most targets will fall into one of those two categories. And if you're the board of a technology company assessing two deals, all things being equal, and one of them is requiring a 10 to 15% escrow that lasts for 18 to 24 months, and the other one is requiring a 0.5% escrow to serve as a backstop on the deductible of a rep and warranty policy, they're going to take that every single day of the week. Strategic companies and real estate companies in general had been wary of rep and warranty insurance for a very long time. Understandably so. The ability to make a claim, the difficulty in making claim, the success rate in getting money from a claim were very low. The rep and warranty insurance industry has grown significantly in the last 10 to 15 years. And now it's a very competitive process. The way I think about it is private equity is probably one of the few industries that, in my experience, is excellent at quantifying risk. A lot of, even in the tech world, a lot of tech strategics get very worried about any kind of risk that arises, and they want to come up with a solution that essentially eliminates all risk. Versus the private equity world can look at a problem and really put numbers around it and probabilities around it and say, this has an X% likelihood of happening. If it does, this is the range it's going to fall in. How do we protect for that amount? As opposed to, overreacting and asking for the moon and the stars. So the way I think about that is if the experts in risk assessment are opting for rep and warranty insurance, they've gone through the numbers, they've looked at the policies, they've really examined what the risk is of not recovering on these claims, and quite frankly, paying, it's about a 1% purchase price is the premium for a policy. If they're comfortable with rep and warranty insurance, then I think that, that's a good indicator that this is a product. It's a real product. It's worth having. And I think it's going to continue to make its way into deals where even you have a real estate or a strategic buyer acquiring some of these tech companies. And we're seeing that, a number of our buy-side companies, they may get it the first time because they're trying to win a deal from a private equity shop. But once they use it, they love it and they keep using it. So I think we're certainly going to see an increase in those kinds of deals. I think there's going to be less earnouts and possibly more rollovers and stock transactions where you see a acquirer offering stock for a transaction as opposed to cash. Cash is certainly at a premium right now, but equity in theory is cheap, and so that's another possibility. I think one thing that the prop tech and real estate industry has continued to struggle with over time is understanding when you're buying a technology company, what it is that you're buying, and effectively, how do you win those deals? And the important thing to remember is that, traditionally real estate is about hard assets, and it's about, it's about the partnership structures and structuring. Technology is not that. Usually the most important assets is the IP and the people. And so the transaction needs to be structured, including with respect to compensation, in such a way that protects those two things, the IP and the people. And I think focusing more on that going forward will mean some more successful acquisitions as we get through this year and next. So I think, Blake, do you want to open it up to questions from there?
Yeah, that's great. Thanks, Ali. That was insightful. I don't know if the Q&A is just the chat here on the. Looks like it.
Yeah, let me mention. Somebody commented in the chat about cross-border transactions. That's definitely an area that we're seeing more and more of. Particularly in Europe, there's both a lot of targets and acquirers that we're seeing, come to the United States and buy technologies here or vice versa. Obviously, cross-border into the United States, there's a little bit of a hiccup there with new CFIUS rules. It just makes the process a little bit longer and a little bit less certain. But in this industry, it's usually not going to be too difficult. But we are definitely seeing a lot more cross-border activity for sure.
Yeah, I agree. I mean, the development or the progression of prop tech in Europe versus in the U.S. is, is at a bit of a different stage, but we're starting to see more expansion, particularly by U.S. investors seeking to go over to Europe, and we're working on some of those deals. And one thing I think, that you said that really resonated with me was the prevalence of stock deals. I really agree with that. I mean, I think that's an easier form of consideration to be able to defend right now, because cash prices are a little bit depressed, and so stock allows the ability to kind of continue on in the investment for the target, and it gives a little bit more security on the buy side. So that's certainly a trend that, to the extent people in the audience are thinking about an M&A deal, it's likely to be the path, and what we're seeing with deals right now. Good question there. You want to take the big tech question, Allie?
Yeah. So I think the question, for everyone's benefit who's not reading the chat, is: do you see big tech, for example, Amazon, Salesforce, Google, Microsoft, being acquirers of these prop tech solutions as they focus on home and office tech sectors? I don't see them doing it in the future. I see them doing it now. Take Apple, for example, which is not on your list. They spent a lot of money acquiring Nest and Dropcam, as examples of them getting into that particular space. I think the IoT market has obviously blown up in a number of areas. You have things like Alexa, which will control more of the home, as time passes. So there's that. But take in Amazon, for example, people movement has always been their business. They have their own delivery service, effectively, that is a heavy competitor to UPS, FedEx, and the USPS. And so they've always been looking for improvements on that infrastructure. And so, in terms of, if we're looking at things like the GPS and tagging and geolocators that we were talking about earlier, they've already been competing. They've already been scooping them all up. That's not going to change. It's just going to make the competition worse. As for some of the other ones, Google, ABC really is what you're asking about here. ABC has a number of subsidiaries in a variety of spaces. As we all know, they've been the turns lately, given the number of spaces that they're in. But I think you can be guaranteed that they will be very interested in trying to figure out some of these technologies and get ahead of them going forward. In terms of some of the older prop tech, hasn't been around that long, more traditional prop tech industries, things like Airbnb and technologies that we've seen for a while, will these guys get into that space? Maybe. I don't know that a lot of them rise to the general revenue stream that they would care about for the industry itself. I think, are there interesting underlying technologies? Absolutely.
Yeah, I completely agree. I think that two of the from the real estate side, two of the subsectors that have thrived have been industrial and multifamily, specifically this year. And so IoT has been everybody's home. So IoT devices are they've just completely accelerated as people are kind of looking to enhance their environment at home. And then Amazon's work in the industrial sector with robotics and other, kind of last mile industrial asset efficiencies has just accelerated as they've looked to kind of fill the supply gap chain that they experienced toward the beginning of this year. So completely agree with your sentiments there. And then there's a question: are you seeing an increase in ESG dedicated prop tech consolidation? I guess I can take that one first. So ESG has the kind of return to work, particularly in the office sector, has challenged a little bit of some of the progress that we had made on ESG over the last 5 or 10 years, particularly on the real estate side. That had really been an area of focus for real estate operators. And I think as companies right now are focused on, I would give the example of the office sector, getting people back into buildings, that particularly environmental consideration.
Blake, I think you may have somehow switched over to be on mute. There you go. Oh, no, you went back again.
At a time, I think that might be the issue. She said this might happen.
Oh.
So anyway, Ali, I don't know if you have anything to add on that final question.
Yeah, no, I echo the same thing. I also think that generally the amount of funds that are going into this have been halted given the current administration, which is important because some of this is also export and what is coming out of a number of industrial sites. And as the regulations change, in theory, maybe in the next administration or maybe the one after that you always see an up or down in the investment in those areas, given more of the geopolitical map than what we're seeing right now. I think that's a question that's beyond our scope as M&A lawyers. I spoke to that a little bit just now. I think that it's less, actually, in my mind, it's less the landlords, the asset managers, and the tenants as it is the developers. Someone made this analogy for me a couple years ago, and it's a fair one that I repeat often. In tech, we plan for 6 months from now. We plan for 12 months from now. We plan for maybe 2, 3, 4 years from now. If you're Apple, you change the world and you plan for the rest of, time. But real estate plans for 30, 40, 50, 60, 70, 80, 90 years from now. They build a building with the expectation that it will be there for some time. And so, our new buildings, I think, take apartment buildings and high rises are being built with the question of, within a very confined garage space, do we need to make not just more room for cars that can fit closer together next to each other, but do we need to make more room because cars are going to be hovering, and so we need a higher ceiling, right? Those are the kinds of questions that real estate developers are thinking through now in trying to anticipate what are the technologies going to be, 10, 15, 20, 30 years from now. It's very much a futurist activity. So in terms of climate change, I think that's where the biggest impact is going to come from, is buildings that are being built, to certain standards that are sustainable over time, and that will make that kind of impact, not just the building itself, but the construction, the materials that are going into it. I think that's ultimately where you're going to see the impact on those matters.
I think that's it.
That's it.
All right. Well, thanks, Ali. Thank you, everyone. Appreciate. Thank you again to CREtech for hosting us today, and we look forward to participating in the rest of the conference this week.